April 21st, 2025. A day where the financial world seemed to be, well, operating on two completely different planets.
Uh-huh.
You likely saw it in your own feeds, stock markets taking a really sharp downturn, while, simultaneously cryptocurrencies were experiencing this significant surge.
Yeah.
Makes you wonder, right? What were the fundamental forces actually at play that could create such a dramatic split?
That's exactly the puzzle we're going to try and dissect in this deep dive. We've got a market analysis and a report from that very day, April 21st.
Okay.
And our goal is really to move beyond just the headlines. We want to get to the core reasons behind this fascinating divergence. What pressures were weighing down traditional markets and, what ignited that bullish fire in crypto.
Okay, so let's zero in on the stock market first.
Right.
This report paints a pretty clear picture of some substantial losses that day.
Yeah, it wasn't great.
The Dow Jones Industrial Average dropped by nearly 972 points. That's what, almost 2.5%?
2.48%, yeah, significant.
And the S&P 500 was down by over 2.3%. And the Nasdaq composite, with its heavy tech focus, it slid even further, losing over 2.5%. Those aren't minor dips. That's a significant amount of value just poof, gone.
Indeed. And the report highlights this confluence of factors acting as a drag. A primary concern was all the uncertainty surrounding U.S. tariffs.
Right.
It's not just the immediate cost increases, but the broader implications for companies trying to manage their supply chains,
Yeah, I can imagine. Like if you rely on components from overseas, suddenly you're facing higher costs, maybe disruptions.
Exactly. That uncertainty makes planning incredibly difficult, and naturally, it makes investors pretty nervous.
It's like trying to build a business on shifting sands, sort of.
Pretty much.
And speaking of things making investors uneasy, the report also points to the very public tension between President Trump and the Fed chair, Jerome Powell.
Oh, yeah. That was heating up.
It sounds like it was more than just like a disagreement on policy.
Precisely. President Trump's very direct criticism, including those stark calls for Powell's removal, labeling him a major loser.
Wow.
That strikes right at a core tenet of market stability. The perceived independence of the central bank.
Which is crucial, right?
Absolutely crucial. The market needs to have faith that monetary policy decisions are driven by economic data, by analysis, not by, political pressure.
And when that trust gets shaken,
it inevitably leads to a reassessment of risk. What we were seeing here wasn't just about disagreement. It's about the market's inherent aversion to unpredictability in its core institutions. The Fed's strength lies in its perceived neutrality, and these attacks just directly challenge that.
Okay, and it wasn't just the political climate, was it? The underlying economic data also seems to have been raising some red flags, according to this report.
That's correct. The Conference Board's leading economic index for March, it showed a 0.7% decline.
Okay, and what does that index actually tell us?
Well, think of it as a collection of forward-looking indicators. Stuff like consumer expectations, stock prices themselves kind of foreshadowing this drop and new manufacturing orders.
Wow.
The fact that it was down with those specific weaknesses, it suggests that the economic engine might be, starting to slow down a bit, like seeing warning signs that the road ahead might get bumpy.
So you've got trade worries, political pressure on the Fed, and these indicators suggesting a potential economic slowdown. It sounds like, a perfect storm brewing.
Exactly. The report calls it a crisis of confidence.
Right.
When these negative forces align, investors naturally become more risk-averse. They start pulling back from assets they see as riskier, like equities, and look for, safer places to park their capital.
And this flight from risk, it was also reflected in the U.S. dollar, wasn't it?
Yeah, definitely. The dollar hit a 3-year low. It fell almost a full percentage point against a basket of other major currencies.
Wow. That really amplifies the sense of unease, doesn't it? It suggests this broader loss of faith in the U.S. economic outlook, maybe policy stability.
Precisely. It signals that diminished faith on a global scale.
So, looking ahead from that day to April 22nd, the immediate short-term outlook for stocks, according to this report, was more of the same.
Pretty much. Continued volatility, continued downward pressure. The suggestion was to maybe consider more defensive sectors.
Like utilities, consumer staples.
Exactly. Healthcare, too. The kinds of businesses that tend to hold up relatively well regardless of the economic cycle because, people still need electricity and food and medicine. Essentials.
That makes sense. Stick with the essentials in uncertain times. But interestingly, the report also mentioned high-yield income funds, even some focused on tech and AI,
Yeah, things like FEP, AIPI, YieldMax AI, and TAC were mentioned.
as potentially offering monthly distributions despite the market turbulence. That seems a bit counterintuitive for tech in a downturn.
It does, but it highlights that the market is rarely, monolithic. Even within a broader downturn, specific segments, maybe focused on generating income through options or dividends, might still offer opportunities, though likely with a higher level of risk, of course.
Right. But the report did advise caution, specifically about heavy exposure to the Nasdaq, right?
Yeah.
Those growth tech stocks.
Yes, definitely caution there. Those tend to experience sharper swings, sharper sell-offs when sentiment turns negative like this.
Okay, so a more cautious approach there. And the report really seemed to double down on the expectation that President Trump's ongoing feud with Jerome Powell would just keep hammering the market the next day.
Yeah, predicting further declines at the open, sustained volatility. The market was expected to remain highly sensitive to any further tweets, comments, anything on that front.
So any new statement could cause big intraday swings.
Absolutely. But it also highlighted the potential, again, for those defensive sectors to maybe outperform and the possible, though riskier, refuge in those high-yield tech funds. Diversification, still key.
And everyone would be watching the Fed super closely, right? Looking for any sign they could maintain their independence.
For sure. Scrutinizing every communication, every piece of economic data.
Okay, let's zoom out a bit then. The report also talks about the longer-term ramifications of this tension between the president and the Fed.
Yes, it really delves into how this can erode investor confidence over time. And what's fascinating, or maybe worrying, is the fundamental principle at stake. The Fed's perceived independence and credibility.
Which we said was crucial.
Absolutely. Repeated public attacks, like the ones described, they chip away at the trust investors place in the central bank. And when that trust falters, well, it has significant consequences.
Like the report mentions increased market volatility and higher risk premiums. Is that what you mean?
Precisely that. The uncertainty around Fed leadership, policy direction, it creates instability. Investors facing that demand a higher return for taking on risk.
Which pushes stock valuations down and makes borrowing more expensive.
Exactly. And the report directly connects this dynamic to the very market sell-off we saw, the weakening dollar we touched on, and even a surge in safe haven assets like gold. People look for alternatives when confidence shakes.
And the report also brings up the risk of, well, policy mistakes if the Fed actually gives in to political pressure, like for rate cuts.
Yeah.
It even references Nixon in the 70s.
It does. And that historical example is a pretty stark reminder of the dangers. Prioritizing short-term political goals over long-term economic stability. Well, it didn't end well then.
How so? What's the risk?
As the report notes, premature rate cuts driven by politics, not economics, could easily reignite inflation or even lead to stagflation, that nasty mix of slow growth and high inflation. Powell seemed cautious on inflation, but the pressure was immense.
So if global investors start losing faith in the Fed's autonomy, what does that mean for, say, the attractiveness of U.S. assets generally?
That's a huge point. The U.S. dollar status, the belief in the Fed's independence, these are major factors drawing international capital to U.S. markets. If that faith erodes, you could see capital outflows. That puts downward pressure on the dollar, potentially destabilizes U.S. markets further. It's a potential domino effect with global implications.
And even the legal ambiguity around whether Trump could actually fire Powell without cause, that uncertainty itself is damaging, isn't it?
Absolutely. It just adds another layer of uncertainty and another reason for investors to be jittery, a persistent cloud of doubt.
So to just quickly recap, the long-term risks the report highlights.
Yeah.
Undermining Fed independence and credibility.
Yep.
Increased market volatility and risk premiums. Heightened risk of misguided monetary policy.
Right, yeah.
Weakening global confidence in U.S. assets and the dollar. And ultimately, potentially greater economic and financial instability. That's quite a list.
It is. And the report really underscores a critical reality. Trust, especially in financial institutions, it can be lost incredibly quickly.
But rebuilding it takes time.
A long time and sustained, consistent effort. The long-term ramifications could be really significant for the U.S. financial system's standing globally.
Okay, let's completely switch gears now. The flip side of the coin on April 21st, 2025, the cryptocurrency market.
Right.
While the stock market was deep in the red, the report uses the word surged for crypto, which, looking at the numbers, feels like maybe an understatement.
It was a truly remarkable contrast, wasn't it? While traditional equities were facing all those headwinds we just talked about, the crypto market showed considerable strength, real upward momentum.
It almost felt like capital was actively seeking an alternative destination.
That's certainly one interpretation.
So let's get into the specifics. Bitcoin, BTC. The report says it jumped from around $65,000 to $72,000 in just 24 hours.
Yeah, a 10.7% increase. Massive.
And the trading volume exploded up 30% to $45 billion. That suggests some serious buying interest.
Exactly. That kind of volume indicates a strong influx of capital, very active participation, real conviction behind the move.
And it wasn't just Bitcoin, was it?
No, not at all. The report notes other major cryptos followed suit. Ethereum, ETH up over 3%, Ripple, XRP up over 3%, Binance Coin, BNB, up almost 2%.
Okay, respectable gains.
And then you had certain altcoins really taking off. Solana, SOL, up 10%, Cardano, ADA, up 8%. It was pretty broad-based strengths across the crypto space.
And the overall mood? The report mentions the Crypto Fear and Greed Index. It went from neutral, 50, all the way to 75, which is greedy.
Yeah, quite a swing. That index tries to gauge sentiment among crypto investors. A move into greedy suggests strong bullishness, a belief that prices are likely to keep rising. Lots of optimism, willingness to take on risk there.
Interesting. The report also highlights strong performance from tokens linked to artificial intelligence. SingularityNet, AGIX, up 12%. Fetch.ai, FET, up 9%. What's the connection there? Why were they doing so well?
Well, what's particularly intriguing, and this was a growing theme, is the synergy between AI and blockchain.
Yeah.
Investors seemed increasingly excited about projects using blockchain for AI applications, things like decentralized platforms for AI services or secure data sharing for AI models.
Oh, I see.
The strong performance of these AI tokens suggests a real belief in the potential of that intersection, like two powerful technologies amplifying each other.
Got it. Now, the report does touch on some technical indicators. Bitcoin's RSI, the relative strength index, was apparently quite high, around 78. What does that typically suggest?
Yeah, an RSI that high, generally anything over 70, often suggests an asset might be overbought. It means it's had a significant run-up in price very quickly and might be due for a pause, some consolidation, or maybe a short-term pullback.
So a yellow flag, maybe?
Sort of. Not necessarily a crash warning, but a sign the rapid pace might not be sustainable immediately. Although, interestingly, the report also noted Ethereum's MESC, another indicator, was still showing upward momentum, so mixed signals there maybe.
And it wasn't just price and technicals. The actual on-chain data for Bitcoin, like network activity, looked positive too.
Yes, the report highlighted a notable 15% rise in active Bitcoin addresses.
Meaning more people using the network.
Exactly. And a 5% increase in Bitcoin's hash rate. Think of hash rate as the network's processing power, its security level.
Right.
A rising hash rate makes the network more secure, more resilient. That's a strong, long-term positive. So these metrics suggested growing adoption and strengthening network health, underpinning the price moves.
Okay. So looking ahead to April 22nd then, for the crypto market, what was the investment outlook presented in the report? Still bullish.
Cautiously optimistic, I'd say. It acknowledged the potential for more gains driven by that strong sentiment.
Right, the greed.
Yeah. But it also advised investors to be mindful of those overbought conditions, particularly in Bitcoin. Bitcoin was expected to remain key, supported by whale accumulation and high volumes.
Whales being large holders.
Correct. But the possibility of a near-term correction or maybe just some sideways price action was definitely flagged because of that high RSI.
But the report seemed more positive, maybe on altcoins, especially AI and DeFi, decentralized finance.
Yes, absolutely. Those areas were specifically called out as showing really promising growth potential, possibly offering attractive entry points for diversification within crypto.
So tokens like AGIX, FET in AI, and maybe SOL, ADA in the broader DeFi space.
Exactly. Those were highlighted as having significant momentum, potentially leading the next leg up if Bitcoin consolidated.
And the advice for investors? Was it just buy everything?
No. More like keep a close eye on those technical indicators, manage your risk, and maybe consider taking some partial profits if you see sharp rallies, especially in something like Bitcoin that looked a bit stretched short term.
Secure some gains, manage the volatility.
Precisely. In a market that moves as fast as crypto, even during strong uptrends, prudent risk management is always key. Taking some profits off the table provides a cushion.
So quick summary for April 22nd outlook. Continued strength likely in crypto, especially AI and DeFi alts. But maybe watch out for a Bitcoin breather due to being overbought. A really stark contrast to the defensive posture suggested for stocks.
A profound divergence, absolutely. The report paints this incredibly clear picture of two markets reacting in fundamentally different ways to the same prevailing economic and political landscape.
So as we wrap up this deep dive into April 21st, 2025, that contrast is it's really striking, isn't it?
It really is.
You had traditional equities grappling with these significant headwinds, the geopolitical stuff, economic worries, and that very public, very tense White House Fed friction.
Big weights on the market.
And then, simultaneously, the crypto market just experienced this surge of investor interest, fueled by technological optimism, especially around AI and blockchain.
Yeah, that seems to be a major driver, a different narrative altogether.
So what's really thought-provoking here, looking at this decoupling, it forces you to ask, right? Could this dramatic divergence signal something more fundamental?
Like a shift in how investors are evaluating risk and opportunity.
Exactly. Across different asset classes. I mean, given the increasing influence of political factors on traditional markets, which we saw clearly here, and the rapidly evolving potential of decentralized technologies, are we maybe witnessing the early stages of a significant reevaluation where investors are placing their capital, their long-term faith?
It's a fascinating question. Is this a temporary blip driven by specific events or the start of a longer-term trend where these asset classes respond very differently to global stresses and opportunities? It's definitely something worth mulling over.